If you miss this week, in fact, in this quarter, this reporting season, you get punished. And it doesn't take much of a miss. Russ, what do you make from that? What is the signal that you take away from it?
Well, good morning, Jonathan. I think the short answer is the market's moved a good deal off of the October lows from last year. We've got some crowded trades. And this is an earnings-driven market. You think about 2023, that was all about repricing. It was all about multiple expansion. And because of that, as you pointed out a moment ago, the market is not cheap. And this is a year where stocks are going to be driven much more by earnings, by cash flow, by profitability. If companies are not showing investors what they like, you're right, they're getting punished very quickly.
JP Morgan, Marko Kolanovic with this to say, earnings expectations are too optimistic. Russ, you appear to take the other side of that.
I would take the other side of that, and there are a couple of reasons. First of all, I do think you've got a number of companies, we all know who they are, that are dominant in the indices that are tremendous at generating cash flow. They've got moats around their business. They are levered to long-term themes, whether that's artificial intelligence, internet commerce, and I think that continues to be a long-term trend. But the simpler answer for most of the companies is that ultimately the top line is going to be driven by nominal growth. And you think about what's happened. You go back to last year, there was still a lot of calls for a recession. And now we've got estimates for 2024 GDP at 2.4%. Inflation obviously is a little bit stickier than everyone would like. But you add that up, and you're likely to get a year where nominal growth, nominal GDP is 5% or north. That's a pretty good environment for earnings. What's expected right now is 244 for the S&P 500. That's around 10% growth. I think if you get 5% nominal GDP, that is a very attainable number.